Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Hump Day. It's Wednesday, October 10th. We got a couple items on the calendar today, so we'll just kind of jump right into it. And we'll start off with the basically it's inflation on the wholesale side of things. So this has some importance, but not a lot of weight to it because the difference on wholesale compared to the consumer side of things is that even though maybe inflation has a slight uptick in the producer side or the wholesale side of things, they get the PCE, which is the Fed's favorite gauge, the PCE, personal consumption expenditure. But this does kind of help us give us some insights to see where inflation is moving. So we'll start with the headline number here, the producer price index for the month of September. So in August, it dropped 0.1%. Forecast was supposed to go up 0.2%, and it did go up 0.2%. However, on the year over year, it did drop a little bit from 2.8 to 2.6, I believe it was. And then now when you take out the food and energy, we got what they call the core PPI, and it followed the same thing. It went from down 1.1%, went up. Forecast supposed to be up 0.2%, and went up 0.2%. Now, the difference on this one is this one actually went up. It went from 2.3 to 2.5% year over year, and that's primarily because the food and energy happened to go down in the month of September. So that's why we got two different directions on this, almost the same thing. But because we had food and energy is the main component, that creates a lot of volatility. So when the Fed looks at these inflation numbers, they usually look at the core primarily because there's no control and it becomes such a variable that there's no control. So they kind of take that out to remove any volatility in the market. So that's why you see food and energy taken out. That's why they look at the core PCE, they look at the core CPI as their main numbers that they're looking at, besides the headline number that you'll see in the newspapers and media and stuff. Last but not least, we got the wholesale inventory. So this is looking good. July it went up 0.6%, and in August it went up a little bit further up, another 1%. So good news right there as well. Let's kind of jump ahead here to the headline news. Stock market's tanking today. I mean, tanking. The Dow so far is down over 400 points right now. Nasdaq is down over 175 so far. So it's really tanking. We do got a few members speaking, but I'll touch on the reason why it's tanking here in just a second here. It's not to do with our economic calendar, but we'll show you in a minute here. The bond market is currently down only about 6 basis points right now. As you can see, we were kind of going down a little bit further. We were actually up. We actually closed upwards about, I think it was like 19 basis points yesterday, but we had what they call a bond rollover. So that means it reduces about 12 basis points on the charts, but that does not count towards the pricing on a rate sheet. So pricing on a rate sheet, basically what happens on a bond rollover is that they package up for the 30 days of bonds, they sell it on Wall Street, and they basically reset and start a new month because it's kind of finite. It just keeps they'll reset the pricing and go in there, but for the rate sheet purposes, it doesn't have any factor into it. It's just sometimes in these bond pages, you'll see a bit of a drop once a month, and that's but again, it has nothing to do with the pricing. So we are currently down about 6 basis points. As you see, we were kind of getting close to this floor of support here. Hopefully, we can protect ourselves. Monday, as you can see, we did touch it. We didn't really quite touch it. We didn't touch it yesterday. We had a pretty good day yesterday. Today we're down a little bit, but that hasn't gotten quite that far yet. We're getting a little bit of reprieve because the stock market, or money's coming out of the stock market, went and the bonds for a flight to safety. So that's why you're getting, it's not as down as much as it could be. It was down a little bit further, and this is really why the market's kind of tanking. We're pushing, the yields are rising here. It was pushing up at the 3.25% range here. Right now we're hanging about 3.21%. Because of the higher yields, they're reassessing with the height of the stock market at such a high level that the cost of borrowing, it gets to be a bit pricey for corporations and investors. But they're also kind of concerned because now you got higher yields. Are some of these investors going to move their funds from the stock market, equity market, into the lock into these higher yields, so that way they can, basically, the reason why they look at that is because it's a high enough of a return for them that there's really no risk to it. So where equities, there's a lot more volatility and risk involved. There's much lower amount of risk, and it might be enough, a rate of return for them to be able to be satisfied without having to take that risk. And especially at where the level of the stock market's at, we've been breaking new highs for a while there. that they may just lock in and lock in at the yields where they're currently at, and for a flight of safety here. So that's why you get concerned about on the equity markets for the higher yields, because it creates competition for them. All right, so rates are about the same as yesterday. We didn't really have much change in pricing, as we're only down about 6 basis points. Uh, it could change later in the day, but so far pricing is about the same where we left off yesterday. If you guys want to check on any updates, you can come over to Twitter. I do post over there under my handle, Mike Bjork. If you guys want, again, you guys want to see if there's any changes in the market, or market close and such, just come over to Twitter, find me at Mike Bjork, and you'll find a poster right there. Otherwise, you guys have a great rest of your day. Thanks so much for watching. I hope you guys enjoy yourselves, and we'll see you guys tomorrow. Bye-bye.